Welcome to Get Rich Education. I'm your host, Keith Weinhold. For a rental property to make sense for you to buy, what should the rent-to-value ratio be today? Then, is it Happy New Year or Happy New Fear? Tom Wheelwright joins me to discuss new taxes, property taxes, and just how onerous cryptocurrency taxes are today on Get Rich Education. Checkbook IRAs have been ruled illegal by the U.S. tax court, with contribution limits 10 times what traditional and Roth IRAs allow. Get total control of all of your IRA funds without paying the nasty UBIT tax with the retirement plan answer left standing, the EQRP. You can invest your retirement funds in real estate, gold, Bitcoin, and even your own business. This works whether you're a solopreneur or have up to 50 employees. Learn more about getting started. Text EQRP in all caps to 72,000. The annual Spartan Summit is on. I was the kickoff speaker at the last event. This year they are back in person, and the keynote speaker is none other than Shark Tank's Damon John. Learn from industry experts on real estate, tax strategy, lending, and entrepreneurship. You'll also get to tour tangible turnkey income property in growing Alabama markets. It's coming February 16th to 18th in Birmingham, Alabama. Get your ticket or learn more at SpartanInvest.com today.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Ashland, Virginia to Ashland, Oregon, and across 188 nations worldwide. You're listening to one of America's longest running and most listened to real estate investing shows. This is Get Rich Education. I'm your host, Keith Weinhold. A common investor question today is that with real estate values soaring about 20% year over year, what should I do now that rent-to-value ratios are lower? And one might also call this the rent-to-price ratio, but despite the name that you use, in most markets, rapid rent increases are taking place, but they have not kept up proportionally to higher property values, and therein lies the reason for the question, and this is a good question. Back, say, 10 or more years ago, it was desirable and possible to get this ratio as high as a full 1%, maybe even more. And what that means is that you would get $1,000 of monthly rent income from a tenant for every $100,000 worth of property purchased. Well, today, a property can be equally profitable to you at a substantially lower rent-to-value ratio, or RV ratio, perhaps even as low as 2/3 of 1%. And then that could mean something like $670 of monthly rent income for every $100K of property that you buy. And now some might wonder, well, how could something like that change so much? Well, I think that the most obvious answer is that mortgage interest rates are substantially lower than they used to be. They're still near all-time lows today. In fact, fully 75 to 80% of your property's cost is in that financing. Well, the rent-to-value ratio, that doesn't account for that at all. So you've got home prices at historic highs and financing costs near historic lows. That's why mortgage payments are not historically that high. Well, a lot of people already understand that, but there's even more to this. Today, there are way more build-to-rent properties. Yeah, so what we're talking about here are rental properties that are brand new construction on day one. That's something that you didn't see so much of 10 years ago. Today, they almost seem more common than renovated properties. So what does that have to do with the RV ratio, though? You might wonder. These new builds, well, they often have lower vacancy and lower insurance premiums, and they have lower ongoing maintenance costs as well. And RVs do not account for any of these three: vacancies, insurance, or maintenance, and they're all lower. Now, regarding both new and renovated properties, well, GRE's formula here is often to have you sell and trade up for more property within, say, 8 years, something like that, depending on the rate of appreciation. So it's this equity harvesting that keeps your leverage ratio high, and consequently avoiding long holds, that hedges you against longer term maintenance and against CapEx layout. So actually, this is why an educated GRE buyer is more profitable over someone else over the long run. So these are all reasons why RV ratios of substantially lower than a full 1% work today, maybe even down to something like 2/3 of 1%. Now we're talking about equity harvesting like that, and oftentimes selling out of a property within 8 years, depending on the appreciation rate. Oftentimes that's what you want to do. But say you have a property in your portfolio that you like so much you don't want to sell it because it's so profitable. Well, then you can do a cash out refi, tax-free, and continue to hold on to that property, but use your cash out refi for even more property. So you kind of have a decision to make there. And this is stuff that should make sense. This is real stuff. Because you believe that the prices or the rents are going to appreciate in the future, well, you might be right about something like that, but that is speculative. So let's just talk about stuff that's real and in the here and now. That's what we're doing here. A couple other things to remember about the RV ratio here is that it is only the top line with you making any sort of purchase determination. Your bottom line is the cash flow determination. So run your monthly rent income minus all of your expenses, and as you know by now, your ongoing operating expenses, they are those non-mortgage expenses. They're best remembered with that acronym, VIMTUM, vacancy, insurance, maintenance, taxes, utilities, and management. Well, you want that to be a positive number, even if it's a small positive number, your rent income minus your mortgage and your VIMTUM. So RV is the top line, cash flow is the bottom line. And when we think about context, be mindful that a 0.7% RV, that could be better than a full 1%. Yeah, if the 0.7 one is in a growing market with a communicated property manager, you're going to do better there than with a full 1% rent to value ratio in a sketchy area where you can't get a good tenant and you can't get a manager that wants to manage there either. So the RV ratio matters, but because it's so simple, it's just two numbers, rent divided by value, you've got to look further in making a purchase decision. Before we bring in Tom Wheelwright to discuss the property tax and cryptocurrency tax climate, I've been helping you buy rental property nationwide since 2014 through our GRE turnkey site. Well, we are on the verge of upgrading that for you with the soon-to-be-released GRE Marketplace. Previously, if you wanted real estate provider reports and their contact information and all of that, if you wanted to know about, say, 3 markets, well, you would have to opt in 3 different times in order to get those 3 reports. Well, by using your feedback, we are close to launching GRE Marketplace, where with just one login and one account, you can get access to all of them, a dozen or 2 of them. And there are also plenty of free educational resources in there. And there's more. Andrea, that runs operations here, she has already recorded videos with the various property managers in these markets, and you can see all of those too. So a real resource to you, a real benefit to you. We are making it easier than ever for you to have a cash-flowing rental property portfolio in the best states and markets. I expect to have more on the launch of GRE Marketplace for you soon. Now, you might have heard of the Mises Institute before. It is named for the famed Austrian economist Ludwig von Mises. Well, the Mises Institute champions and advocates for free market principles and libertarian ideals. The president of the Mises Institute will be here on the show with us next week. This will really bring a remarkable balance to the show that we had last week, where we discussed modern monetary theory and universal basic income. I'm coming to you from Anchorage, Alaska today. Yeah, both I and my guest, Tom Wheelwright, CPA, are in, I suppose, extreme climatic areas today. I am in the subarctic, and then Tom joins us from the Sonoran Desert. That is Greater Phoenix, Arizona. Let's talk to Tom. I'd like to welcome back the most recurrent guest in show history. He is the founder and CEO at Wealthability, and he really specializes in helping business owners and real estate investors and others reduce their taxes to almost zero. He's the author of the mega popular book, Tax-Free Wealth, and he's the Rich Dad Tax Advisor. He is CPA Tom Wheelwright. Welcome back.
Thanks for having me, Keith. Always good to be on your show. Always good to be with your listeners.
Oh, it's always such a good high energy chat. And there's so much to talk about when it comes to taxation. And a lot of times we talk about that in a national perspective because a lot of those gains types like capital gains and income tax rates are all tied nationally, but they're also specific state by state tax laws, very tied into what Congress and the legislature are often doing. Tell us about some of those more noteworthy United States state specific taxes, Tom.
In a show we did a couple of months ago, you mentioned property taxes. And property taxes are a huge tax burden, particularly on real estate investors. And there are actually some things you can do on your property tax. So they can be challenged. And unlike the IRS, you don't have to wait to be audited. You can actually affirmatively challenge with your county assessor. And so you just hire a property tax professional, and what they're looking at is, are you paying more proportionate to your value than your neighbor? Are there any mitigating circumstances that might help you reduce your property tax? It's something that every real estate investor should be paying attention to, and very few do. That would be one area that definitely I think real estate investors ought to be paying attention to. The other interesting area, this is a kind of a new thing that's going on with the states. We have about 20 states now that have enacted an entity level tax for pass-through entities. And the purpose of this tax, it's always elective, but the purpose of it is to deduct your state income tax. So not going to affect you up in Alaska, not going to affect our folks in Texas, but in a lot of parts of the country, state income tax is still a pretty big deal. And of course, we've had this $10,000 limit on deducting your property tax and state income tax. So it's this combination of taxes. So here's what at least 20 states have done so far, is they've said, well, look, if you have a business and you elect, you can pay tax at the business level instead of paying that tax as an individual. Well, what that does is the IRS has said, if you do that, you can deduct your state income tax. That's where, and by the way, you can do the same thing with property tax. If you have your real estate, that's a real business, your real estate's a little different because your real estate, you get to deduct your property taxes no matter what. So your real estate has their own special rules. You get to deduct them. You don't have any limit on your property taxes on your real estate because it's income producing property. But on your income tax, any income tax, if you look at your income tax, you go, wow, it would be cheaper for me to elect to pay tax at the entity level because of that state tax deduction. They might want to consider doing that. Arizona just added that to their laws. There are a lot of other states that have added that to their laws. And like I said, 20 states so far have added that. So regardless what Congress does or doesn't do with respect to income tax on deductibility of state income tax, you do have this year-by-year election. One thing to be really aware of, Keith, is that when you make that election differs state by state. So for example, in New York, you had to make that election for 2022 by January 15th of 2022.
The first 2 weeks.
You don't get until the end of the year to make that election. So you have to guess. Basically, you have to project out, is it better for me to pay the tax at the state level, at the entity level, or should I pass it through and pay it at the individual level? Other states, you make it when you file your tax return. So make sure that your tax preparer and your tax advisor, that they understand what state you're in and how and when to make that election.
Gosh, that is such a key tip. And I didn't think New York would make things any more relaxed with taxation. I really didn't think that they would be the ones. Well, Tom, when we look across the state-by-state landscape, some might wonder now, why do states have certain tax plans, whereas others try to go a different direction? For example, you mentioned Texas earlier, where they don't have any state income tax, but yet they have a fairly high property tax in Texas. So what incentivizes or disincentivizes certain states from certain tax types? What's the motivation or the correlation there?
It's interesting because you're right. I mean, states are going to collect their pound of flesh one way or another, right? Some collect more. You know, California has a much bigger per capita budget than Texas or Arizona even. Same with New York, New Jersey, and some of the Midwestern states. Those are policy decisions, very interesting policy decisions. I've had clients who have moved to Texas this year to avoid state income tax. And so state income tax is a big deal. I mean, if you look at California and you've got a 13.3% state income tax rate and you're making $1 million a year, that's $133,000. You are not going to make that up in property tax unless you have a really big property in Texas. So states can get their money either from income tax, property tax, or sales tax. Texas relies heavily on property tax and sales tax. Arizona, it's pretty evenly distributed between sales tax, property tax, and income tax. Property tax, by the way, is also used heavily for schools, fire departments, and police departments. And so if that's what you want to fund, then you tend to fund those with property tax as opposed to funding those with income tax. There are some cities now. Portland just enacted an income tax for the city. So this is not just Oregon. This is the city of Portland enacted its own income tax. Washington, state of Washington, the governor just by declaration added a capital gains tax. Washington has inheritance tax and estate tax. Very few states have that, but Washington has one. So we think Washington is a no-tax state. It's not a no-tax state. They have their B&O tax, which is basically a tax on everything. And then they have their property taxes, and then they have sales taxes. And now they've got inheritance tax. Now they've got a capital gains tax. So don't believe anybody when they say we have no taxes, except maybe Alaska, which really has very low taxes overall. Though I don't know, with the current administration cutting down all the drilling up there, next thing you know, you're going to have an income tax.
Yes, and once a new tax is introduced, they don't seem to go away. I know that in Anchorage, Alaska, yes, it's known for having a very light tax burden. They recently introduced a 5% alcohol tax. I don't think that that's ever going to go away once people get used to paying it. And once they get used to paying that, it's more likely they'll get used to paying other consumption taxes on cigarettes or gasoline or whatever it is. It just seems like...
Hey, when it's dark 8 months a year, man, you got to be drinking a lot of alcohol. So that's got to be a big revenue raiser.
You can't tax beer in the winter months. That's just downright wrong. Are there any other important trends when it comes to property taxes within certain states, Tom? These things just seem to increase more often than they're ever repealed or go away from my perspective.
Yes, you really have to be careful with property taxes because the assessors, these are not the best and the brightest, right? These aren't the highest paid individuals in the world. So you need to make sure you check your property valuation and make sure that it's appropriate and make sure that you challenge it really every year. I mean, you should challenge your property tax, especially on your rental properties. You should challenge your property tax every single year. Typically, how a property tax professional gets paid is a percentage of the savings. So they don't save anything, you're not out anything. So I don't know why people wouldn't do this every single year. I know big developers, they always challenge their property tax. Always, always, always. So that's one trend to consider. I think another trend to consider is that, again, let's go to the positive side of things, is that more and more states are enacting tax credits for charging stations and solar panels and windmills and, other, like Oklahoma did a huge campaign and got people to put in hundreds of charging stations in Oklahoma. And typically when you see that, it's going to be done through a tax credit. Now, sometimes it'll be done through a grant. In the infrastructure bill, for example, that passed in September, October, in that infrastructure bill, there are some grants for charging stations. The other thing to look at is that we think about tax credits, tax benefits, but don't forget that there are a lot of grants out there, and they have the same effect as a tax credit. And so understanding what those are in your industry, your business, could make a big difference to your bottom line.
Now, when it comes to challenging one's property taxes in order to get it reduced, what typically is the solution, or what does one cite there? Does one cite comparable properties and try to get the reduction that way? So what works when one challenges their property taxes versus what does not work?
You're looking at a couple of things. I'll give you an interesting example. So years and years ago, I challenged the property taxes on my new built personal residence. And I went in, I said, look, I looked at my next door neighbor. I said, per foot, there's no question that you've valued my house way higher than his. He had a 2-story house. I had a 1-story house with a large basement. I lost. And the reason I lost, and had I really thought about this when I built the house, I would have changed the way I built the house. Because what the regulation said in my county were that if your basement was less than half the size of your main living area, then it was considered part of the main living area instead of considered a separate story. So that meant that even where a basement typically is worth less than a second story, in Maricopa County, if you had a basement, let's say my basement was 1,000 square feet, my main floor was 2,300 square feet, so it was less than half. My base had been 1,500 square feet, I would have gotten a lower valuation than with my basement being 1,000 square feet, because they considered it now a 3,300 square foot ranch house, which of course has a better valuation than a 2-story, 3,300 square foot house. There's little things like that. And that's why I typically would hire a professional to go in and look at it for me. But it's one of those things that even before you buy a property, like for me, had I looked at that before I built the property, I didn't even consider it. Shame on me. But if I looked at that before, I would have just built a bigger basement. That's what I would have done. I mean, I could have used the room, so why not? And because it wouldn't have been that expensive to build another 200 square feet, which is really 200-300 square feet is all I needed. Then I would have been fine. There are things like that. So you do look at comparables. There are technical rules that you look at. Like I said, in my case, I lost because of a technical rule, but there are just as many times where you win because of a technical rule where you say, well, look, I'm a real 2-story house, so I shouldn't be taxed the same as this 1-story house next to me. There's just all sorts of little nuances, and it's worth taking a look at.
Yeah, that's so interesting because most builders are thinking about things like a property's livability and utility, right, or perhaps how much rent they can get. And they don't often think about long-term ongoing taxation when they develop. Well, Tom and I are going to come back and talk about cryptocurrency taxation. You're listening to Get Rich Education. Our guest is Tom Wheelwright. I'm your host, Keith Weinhold. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They've provided GRE listeners with more loans than anyone, and it's where I got my last few loans. They finance single-family income property up to 4plexes. They're the #1 lender for beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and get your custom plan for expanding your cash-flowing portfolio. Start at ridgelendinggroup.com. You can get a 50-year-old house somewhere or buy a new one directly from the builder with tenant resilient amenities already built in. With over 3,000 Florida units at different construction stages, they are exclusively for investors. President Wagner and Alaska and team also invest strongly in their own product. That's belief. Start at buildtorentdirect.com. That's build the number 2 rentdirect.com, or text 407-927-5074.
This is Rich Dad, Poor Dad author Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. And the reason I respect Keith, he's a very strong, smart, bright young man.
Welcome back to Get Rich Education. We're talking with Tom Wheelwright, CPA. He's the Rich Dad Tax Advisor. He's the most recurrent guest in Get Rich Education history. He's such a familiar voice, you don't even need an introduction anymore. And Tom, we have never talked about cryptocurrency taxation, something that's really gotten a lot more traction and a lot more institutional buy-in in just the past 2 years or so. And it's seemed to become fairly mainstream now, but a lot of people don't understand the tax consequences that are related to cryptocurrency. So what can you tell us there?
I'll tell you 2 things to start out with. One is there's more we don't know than we do know, but that's actually not a bad thing, because I've always preferred to have no rules than to have rules, because if I have no rules, I can pretty much just kind of follow what I think it ought to be, as long as I can make an argument for it. So I'm actually not unhappy with that, but we'll start getting rules. For example, in the infrastructure bill, they're going to make Coinbase and the other exchanges, they're going to make them keep track of your cryptocurrency transactions. Yeah. And that's actually a pretty big deal. And I think that's a good thing. Here's what's interesting, I think that most people miss on crypto. And that is that you are taxed on a sale or exchange, not just a sale. Let's say, for example, you trade your Bitcoin for Ethereum because Bitcoin has not gone up nearly as much as Ethereum in the last year.
Right.
So let's say you say, oh, I'm going to get in on Ethereum. I'm going to trade my Bitcoin for Ethereum. Well, you've sold, for tax purposes, you sold your Bitcoin. So you have a gain or loss based on the difference between what the price you paid and the value in dollars of the Ethereum you bought. Then it gets more difficult. For example, you have a Bitcoin credit card. Now, some Bitcoin credit cards, every transaction, it's like a debit card, and every transaction comes out of your Bitcoin account. Guess what? You have to track every transaction and report it on your tax return. Every single transaction where you use Bitcoin. You buy a cup of coffee with Bitcoin, that's a taxable transaction.
Right. There's no de minimis exemption.
None at all. A better credit card, by the way, would be one where they just charge you. It's like a real credit card, and they charge you at the end of the month. Then you only have 12 transactions. You don't have 365 transactions or 2,000 transactions. You only have 12. That's a much better way, frankly, to do that. And I think we're going to see more and more of that. The other thing to remember is now we've got alternative aspects of crypto, like NFTs. I'll give you a brain twister here. Back in June or July of 2021, Gary Vee, a lot of people know who Gary Vee is, very popular speaker and writer. He promoted a seminar, and the ticket to the seminar was one of his NFTs. And you had to use Ethereum to buy the NFT, which got you into the seminar. So here's the question. So we know when you use the Ethereum, whatever the value was of that NFT / conference, you have gain or loss. Okay, that's the easy part. But do you have a deduction? Let's say it was a seminar that would be deductible to you because it's part of your business. Is it really deductible? Because an NFT is an asset. If you get an asset and then you get seminar as well, is it like partially deductible? Is it fully deductible? Is it non-deductible? These are questions we really don't know the answer to. Now, we can make logical assumptions. We can look at what's the value of his past seminars. So we can kind of take a look historical, and we can probably say, well, that's probably deductible, and the NFT would be the difference. Now, what's interesting about his NFTs is that they are now, the NFTs that people bought to get into a seminar are worth way more than they were when they bought them. So they've actually gone up in value, and there's a trading platform for NFTs. It gets really interesting. And then you have mining, you have airdrops, you have all these different ways of earning cryptocurrency. And then the question is, let's say I mine cryptocurrency. And mining cryptocurrency really is not a whole lot different than mining gold or silver, right? I mean, you're literally mining it. You're just doing it digitally instead of in the ground. Well, if you mine gold, you don't pay tax on that gold until you sell it. So if you mine crypto, why do you have to pay tax when you get it? Well, the IRS says you pay tax when you mine it, not when you sell it, because it's immediately exchangeable into US dollars. Well, here's the problem. So is gold. It's no different than, let's say, I manufacture a vaccine. You can immediately turn that into money. Let's say that you just store it, though. Is that taxable? Not until you sell it. The important thing when it comes to things like cryptocurrency, and we're going to get a lot of new stuff coming down the road, is to look at the fundamental principles of taxation. And this is why when you hire a tax advisor, you want a couple of things. One is you want somebody who really understands the fundamentals of the tax law and isn't just reading the IRS forms. Second of all, you want a tax advisor who can think, who's actually looking at, okay, how would I apply this? And how can I make this a better situation for you? Or how could you make this a better situation for you? You really want to pay attention. I think the good news is I think tax advisors are going to get more and more important, and there are fewer and fewer of us. So we're a little like Bitcoin. We get more valuable all the time, and there are fewer and fewer of us.
That's right. There's a fixed supply there. And Tom, to do a little review, and I think part of what you're telling us is actually if you're a holder or hodler is what they're called in the cryptocurrency world, and just hold on to what you've got, that's your simplest tax treatment there is right there, because you let us know if you sell or exchange cryptocurrency, there is taxation. And I think it's important to talk about that rate. We are talking about it's subject to capital gains tax rates. Is that right?
It is right now. It's considered property. And so it'd be frankly no different than if you sold land. And so it's either long-term capital gains because you held it more than a year, or it's short-term capital gains because you held it less than a year. If you're a dealer, it's inventory. So it's going to be taxed as inventory. It's going to be ordinary income if you're a dealer. But if you're just a typical investor, it's going to be either short-term or long-term capital gain or loss.
And it's certainly interesting to talk about this legislation and these laws as they unfold, especially when one understands that SEC Chair Gary Gensler, he used to teach crypto classes at MIT. Increasingly, you seem to have these Congress members where you learn that they own cryptocurrency as well. So sometimes the people making the policy look out for it if they're a holder of it themselves.
For sure. Why do you think we didn't get an estate tax on real estate? Because the people in Congress, they own real estate. They didn't want the estate tax on the real estate. So you're absolutely right. It's just something you pay attention to. Have good advisors, have a good team. Just like anything in real estate, you want to make sure you have a good team and good team members and people who are paying attention.
Tom and I might continue to talk about this on future episodes. I mean, just imagine in the future, if you as a rental property owner, you begin accepting rent payments in cryptocurrency, or you do other real estate transactions or purchases or sales in cryptocurrency. If you're trying to value your apartment building in cryptocurrency and say Bitcoin is something that's really volatile and it doubles in value, well, therefore your apartment building over just a period of 2 weeks might go from a value of 50 Bitcoin down to 25 Bitcoin. Your building didn't lose any value, but Bitcoin doubled in value, and all these sorts of scenarios which have really interesting tax consequences.
Yeah, it's fascinating. And remember that there are a number of countries who have outlawed crypto, right? Beginning with China and several South American countries. So you also have to pay attention to that, especially if you're in other countries. I don't think it's going to get outlawed here. I think that they will regulate it through taxation like they do most things. Remember also, they could add, if they decide they don't like crypto, let's say the US comes out with its own digital currency, which is likely, they might just say, you know what, we're going to make crypto tax the same as gold, which has a 28% rate, not a 15 to 20% rate. And they could just raise the tax rates on it. That is one way they could regulate it. And the other thing they're going to do is they're going to require more and more reporting on crypto, because we do all know there are some bad actors that use crypto for underground and nefarious purposes.
Yeah, 100%. Well, Tom can help you with this as well if you're interested in reducing your cryptocurrency transactions, in addition to being helpful with real estate and for business owners. Tom, if someone wants to learn more about you, what's the best way for them to get started with how you can help them?
I would go to wealthability.com and just click on schedule a call, and we're happy to look at your tax return. We're happy to see if there's a way we can help. And then if you just like a little bit more education, just pick up my book, Tax-Free Wealth. It's a really easy read. I've actually had people tell me it was a nice beach read. I'm going, I think you're a little sick if you're reading about taxes on the beach, but truly,
only you would do that.
Truly, I was told that it was a nice beach read. So it's a really easy book to read. Nothing complicated in it, not a lot of numbers. It's a way to get more financially educated.
Tom, it's been enlightening. As always, thanks so much for coming back onto the show.
Thank you. Anytime, Keith.
It's really surprising to a lot of cryptocurrency owners that you are taxed on crypto on both the sales and the exchanges. Yeah, if you trade Bitcoin for Ethereum, you have a tax consequence. Tom's take is that he does not think that the U.S. will outlaw crypto like some other nations have. Instead, they will regulate crypto through taxation and more reporting. To give you more of an idea of how onerous cryptocurrency taxes already are, I was talking to Tom some more, just casually outside of today's show here recently, and I learned that you are taxed on the interest that is being generated in the interest-bearing accounts of crypto banks. Yeah. So, for example, people that hold their cryptocurrency at what I'm calling a crypto bank, like, for example, are BlockFi or Celsius. Well, if you're storing 10 Bitcoins at a crypto bank like that, in order to get, say, a 1% annual yield, well, that tenth of a Bitcoin that they would pay you in interest annually in exchange for you storing your 10 Bitcoins there, that interest gets taxed before it's ever converted to dollars. So that's what I mean about this being onerous. Of course, we're a real estate-centric show here, and real estate investors seem to get all of the tax benefits and not so much of the onerous stuff. Big thanks to Tom Wheelwright today. Again, next week it will be the president of the Mises Institute making his GRE debut with me right here on the show next week. Besides our flagship show that you're listening to right now, one great free way to get education and resources to help you build wealth faster is with our free newsletter called the Don't Quit Your Daydream letter. And unlike other platforms, I actually write this newsletter myself. You can get it free at getricheducation.com/letter. That's getricheducation.com/letter. And with the way that media works today, my goodness, you've got to ask yourself, is this the golden age of quality newsletters or what? Because news websites, they are increasingly riddled with paywalls and banner ads and pop-ups about cookies and all this annoying stuff. And then a lot of times the content doesn't really even build durable wealth for you anyway. You get informed, but you don't get anything actionable. Well, my weekly letter does both of those things for you, and it wires your mind for wealth. It helps you make money in your sleep, and it updates you on important real estate investing trends. The letter is full of value, devoid of hype. It is just real content that makes a difference in your life. Rather than living below your means, learn how to expand your means. Get top investment property news in just about a 5-minute read. It is a great free gift for yourself in the new year. I'd love to be a bigger part of your financial education in the future. You can do that right now, totally free at getricheducation.com/letter. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.